Hello everyone, welcome back to another video. Today we'll be explaining waterfall distributions in Excel. This video will first explain to you in a concise and understandable way how waterfall distributions work, and then I'm going to show you step by step how to create your own waterfall distribution in Excel with monthly cash flows, which is something that other videos on YouTube are not showing you how to do. Finally, at the end of the video, whenever you want, you can go into the description and download a free Excel template that works that you can use today. So let's get right into it. A waterfall distribution is really just a way to share and split profits at the end of the deal. And so the way how this gets formalized in real life is a sponsor, a person who's running a deal, a person who brought the deal, will bring the deal to an LP or a limited partner or a private investor, and they're going to agree on some terms, and then they're going to formalize those terms in a JV or an LLC agreement. So for example, let's say that we bring in an equity partner and they put up all the money. We might split profits like this. First, the investor is going to get a full return of capital, so they're going to at least make back their money, and they're going to make an 8% IRR on their money, so an 8% return per year. And between getting their money back and making an 8% return, there's no performance fees that are going to be applied. So 100% of the profits will go to the limited partner. After that, the limited partner makes an 8 to 12% return. We're going to be splitting those profits 80-20. 80% to the limited partner, to the investor, 20% to the sponsor. Between a 12 to a 16% return, we're going to split those cash flows 70-30. And then after a 16% return, we're going to split cash flows 60-40, with 40% going to the sponsor or the syndicator of the deal. So you can see here that the benefit becomes incrementally better for the sponsor as the returns increase. So on this slide, I'm showing you how the waterfall distribution actually gets memorialized into a legal document. And here we have an example LLC agreement. So let's just go through this real quickly. So this limited liability company agreement is a binding outline of the terms regarding the formation of a special purpose entity, XYZ holding company. This will be the company that actually owns the real estate, between Sponsor Co. LLC, the sponsor, the person bringing the deal, putting it together, Investor Co. LLC, the investor. Together, the sponsor and the investor, collectively members. So now there will be multiple sections to an LLC agreement, but we're going to skip ahead to Article 6, distributions. Distributions of net distributable cash. Now this is a term that will be defined in another section of the LLC agreement, but for the most part, it's going to be any profits or cash that are available to be distributed that don't need to be held as an operating reserve for interest payments or maintenance, things of that nature. So how is everything going to flow? First, the members, so both the sponsor and the investor, are going to split pro rata according to their percentage interest until all of the members have received a 7% priority distribution. So what this means, if the sponsor puts 10% and the investor gets 10%, they are going to split everything 90-10 until both have received a 7% priority distribution, which is really the preferred return in this case. Second, 80% of the cash flow. So after they've made a 7% return, 80% is going to go to the members pro rata to their percentage interest. So 80% will be split 90-10, and the other 20% will go to the sponsor until the members have made a 12% priority distribution. So really, once the investor has made a 12% priority distribution, we'll go to the third line, where 70% will go to the members, and that 70% will be split 90-10, and then 30% will go to the sponsor. And then after that, 60% will be split between the members pro rata in accordance to your percentage interest. So again, 90-10, and 40% will go to the sponsor. So really, at this level here, the sponsor is actually making closer to a 46% split on everything, since they're getting 10% of the 60% and then 40% of everything else. So Now the next step is going to be that I'm going to show you how to actually do this in Excel. So before we go into that, I'll just give you a visual example of how the waterfall distribution works, and this will help you when it comes to building the Excel to actually understand all of this. So the black line here represents the profitability of a deal, and then here we have the different hurdles. So for example, the 8% preferred hurdle, the investment return, which is the black line, and the LP's return, which is this blue line, they match up because there's no performance fee being applied. But between 8 to 16%, there's a small performance fee, say a 20% fee. Between 16 and 24, the fee increases, and so the slope of the line of the LP's return diminishes because more of the profits is now going to the sponsor, and the sponsor is making incrementally a larger percentage gain. So after the 24% hurdle here, for example, a lot of the profits is going to the sponsor, and the sponsor is really getting a lot of the benefit, if not most in this example, of any further appreciation or upside. So before we jump into the Excel portion of this, I'll invite you to visit the links where you can download the template. You'll have two options. One of them will be linking to my website. You can download the Excel. The second one here is go to the Streetwise Modeling link, where here you'll get access to a free course. It's completely free. And there's some other videos that I have here and other resources, but you're going to go to this one, JV and Waterfall Structures, and you'll be able to download the template right here. All right, so now that we have the file open, we can review what we're looking at and then go ahead and explain to you how to build this step by step. So if you haven't already, please go ahead and download this model. Here is the project level equity contribution, which are these coming from these cash flows here, which are just sample Excel cash flows. Then we will be showing the limited partner, the equity, the profits, the multiple, and the IRRs. This is all showing blank because the model is not built out yet, but then this will populate. And then here we'll be able to put how much money is the general partner contributing to the deal. And then we will also be showing the splits right here. So between a 0 and an 8%, there's a 0% performance fee. Between an 8 to a 12%, there's a 20% performance fee, so on and so forth. Anything after a 16% performance fee gets split 60-40 between the sponsors and the members. Then here on the annual cash flow, we're just showing a roll-up of the returns by each person. And so that's it. And then here what you would be doing is, for example, this version's already fully built out. The only thing you have to do is connect your model to the cash flow to equity and the dates and match those up. So let's get started. First, we need to work on the tier 1, which is right here. And so let's just get started. The concept here is that we're going to be running a balance that's going to increase with all the negative cash flows, and that's also going to accrue an 8% return on those cash flows, and then that balance is going to be paid down by any positive cash flows or profits until tier 1 is fully paid down. Then we'll go into tier 2, so on and so forth. So we'll explain to you how that all works. So first, beginning balance, it's going to be 0, but what we'll do is make it equal to the previous ending balance. Investor injections are going to be equal to the negative of the min of this or 0. So if we get a positive number here in F32, the formula will put a 0, and then we're putting the inverse of that so that we can calculate this more efficiently. So investor accruals, so we're going to be doing the beginning balance times 1 plus the preferred return here. We're going to anchor that. We're going to take that to the power of 1/12 since we're doing a monthly model. And then we're going to open those brackets minus 1, and we're going to press enter. And then we're going to do the tier 1 distribution. So here, what we're going to be doing is we're going to do the minimum of the beginning balance plus the investor accruals, or the max of the cash flow to equity times 0 times the members split. And we're going to anchor that. And that's going to go. And we're also going to make this put a negative here in front of the formula. Ending balance is just going to be the sum of everything. So let's go ahead and take that all to the right. Do Shift Control right arrow and then Control R to paste the formula across. Now let's check if we did this correctly. Okay, so negative 10 million shows here. We have another negative 1 million, and then here we have the investor accrual that's accruing on whatever the outstanding balance is. So we'll go all the way to the right. Here we have the accruals, the positive cash flows, which are counting against the accrual. So you can see that the preferred return accrual is reducing. And then here, when we do the refinance in this cash flow, when we get a $15,000 payday, it's taking the balance all the way down to 0. Okay, so that's very good. So now what we're going to be doing is calculating the LPGP cash flows as well as the promote, or the what's also called the performance fee. So LP cash flow, very simply, is going to be negative investor injections minus tier 1 distributions multiplied by the equity contribution. Okay, so what I'm going to do is G6 and anchor that, negative 9,000, and then we'll do the same thing here for the GP, minus 10,000 here, minus the distribution times the 10% equity piece, and then the promote is going to be the distribution divided by the member split multiplied by the performance fee, which happens to be 0. Let's take those three all the way to the right. Let's make sure that it's calculating correctly. So negative cash flows, negative cash flows, negative cash flows. Very good. Here we have the 90-10 split on any profits between the LP and the GP. And then right here where this is summing to 14.49, same thing here. And so now what you'll see is this 14 million, it's not adding up to 15, because actually what we've done is we've paid off all of the first hurdle, and now we're going to be flowing some capital into tier 2. So the tier 2 capital is really just going to be equal to the cash flow to equity minus the sum of everything here. Boom. And we're going to copy that formula all the way across the entire bottom. So here we have no money going to tier 2. Here we're showing that 503,000 is going down to tier 2, and then everything after that is going to the second hurdle because we fully paid off tier 1. Now another thing that we'll do is what we'll check is make sure that the tier 1 is calculating correctly by just connecting it here. We'll take it all the way to the right, Control R, and we can see here that all of the cash flows from tier 1 are adding up to an 8% IRR. So we know here that this is correct. So once the LP has made an 8% IRR, then we go to the second hurdle. So now we'll do the same thing. Beginning balance is equal to the prior ending balance. Investor injections, we can just connect it to here. It'll be the same thing. Investor accruals, now this time we're going to be running a different percentage. So it's still the same 1 plus, this time 12% to the power of 1 divided by 12. We'll close that up. Tier 1 distributions will be equal to the same tier 1 distributions as before. Now this time the accrual will be equal to the min of the beginning balance plus investor accruals plus the tier 1 accrual distribution or the cash flow for tier 2 multiplied by 80%, because only 80% of the cash flows in tier 2 are going to the members. The other 20% will be available for the general partner in the form of a performance fee or a promote. Then we're going to sum everything up here, and we can go ahead and take this all the way to the right. Now the accruals, here I forgot to do minus 1. Okay, take it all the way to the right, and let's just check that this is correct. So minus 500, minus. Here we also forgot to put the minus sign here. So let's go ahead and do that. We're going to add a minus, shift control to right arrow, control R, sorry. Okay, so now we can see here that our cash flows are properly calculating. So now that we're here, what we'll do, we'll take it all the way back here to the left. So the LP cash flow for tier 2 is going to be negative of the tier 2 distribution multiplied by the 90% investment. Anchor that cell. Negative tier 2 distribution times 10% for the GP. And now the promote will be equal to what's available for tier 2. We're going to divide it by the same 80%. So we're dividing by 80% to bring it back to a full 100%. And then we're going to multiply it by 20%, which is the performance fee. We're going to take that all the way to the right. Let's check that our cash flows look good. Okay, again, we need to insert a negative here to make that right. Control R. And then here for cash flow available for tier 2, we're going to do cash flows for tier 2 minus everything that we distributed in tier 2. So let's take that to the right, and then let's just check our formulas once again. So here we can see here that $50 million paid off all of the first tier, the 8% preferred. Then we flowed into the second tier, which was up to a 16% IRR. The sponsor was entitled to some of the promote. So of the 500,000 that flowed into tier 2, 360 went to the LP as a return on their investment. 10% of that went to the GP as $40,000, which was their return on their investment, and then 20% of the 500,000 went to the GP as a performance fee. So that's that 80-20 split. After the tier 2 hurdle got paid off here, and then this amount of money now went to tier 3 to be paid off. And we're going to do one more thing here, which is we're going to check that the LP tier 2 is working correctly. So we're going to do the tier 1 plus cash flows that are going to the LP in tier 2. We're going to go take that to the right, and we can see here that once the LP is making a 12% return on their money, all further cash flows now go to tier 3. So that's how we know that we're doing this correctly. So now let's go to tier 3. We're going to do beginning balance is equal to the prior ending balance. Investor injections are going to be from tier 3. Investor accruals, beginning balance multiplied by 1 plus 16% to the power of 1/12 minus 1. Tier 1 distributions will be equal to tier 1 distributions. Tier 2 distributions equal to tier 2. And now the tier 2 distribution is equal to the min of the beginning balance plus accruals plus tier 1 accrual distribution plus tier 2 distributions, or the cash flow for tier 2 multiplied by, so this is, we're on the third tier, by the 70%, Boom. And we're also going to put a negative sign in front of this. Then we're going to sum everything to find the ending balance. Oh. And then we're going to take this all the way to the right. Once again, we're going to check our logic. So we're going, all the accruals, we're getting negatives. Very good. Negatives, very good. Until the whole tier 3 is paid off here. So now we'll go back to the limited partner cash flows. So anything that's a tier 3 distribution here is going to go 90%. Then we're going to take it here, multiplied by 10%. GP promote will be the tier 3 distribution divided by 70, multiplied by 30. And we'll take this all the way to the right. Cash flows for tier 4 will be equal to this minus the sum of everything here. Now, I have a feeling I may have forgotten the negatives once again. So let's go ahead and enter negative signs here. Let's just check. Negative. And once again here, negative. So we'll do here. We'll take everything to the right. And we'll check the formulas once again. So here you got all positive cash flows. Very good. Now we're getting here to the last tier. Now the last tier will be just slightly different. There's no more accruals because everything over. Actually, let's run the check one more time. So let's do plus, find the LP cash flow here, and oops, let's take it all the way to the right. And here we got our 16% return. So once the LP made their 16% return, everything now is getting split 60-40. So let's go ahead and do that. So LP cash flow will be what's available for tier 4 times 60% times their designated 90% contribution. The GP will get the same treatment, 60% times their 10% contribution. And then the promote or the performance fee will be cash flows going to tier 4 times 40%. Then we'll go ahead, we'll take that all to the right. Let's just check our numbers. We'll go all the way. Once again, the sum of this is 5.57, so we're matching. And the tier 4, let's go ahead and calculate that one as well, is going to be this one here plus LP cash flow. And we'll take that all the way to the right, Control R, 21.5%, 21.5%. So there you have it. We've built the whole cash flow mechanism. Let's just review everything real quick. So here we have our annual cash flows, negative $20 million in investment, $3 million, $23 million, and an $8 million over a 4-year life cycle. And we can sum everything up. We can see the profit here is 14.5 million, 14.5 million. So even though the general partner only invested 10% of the equity, they're getting a 32% allocation of the profit. So as a result, they've essentially 3.35x'd their initial investment. This is their profit. And their IRR went from a deal level IRR of 27% to 62% IRR. And the limited partners IRR went from 27 to 21.5. So if we made all the performance fees 0, you would see here that the limited partner and the general partner would be making the same, right? So their dollars are being treated pari passu. But because of these performance fees, what's happening is essentially the general partner siphoning off profits from the limited partner to the general partner and increasing their return. And so that's how developers are really able to make a lot of profits with a little bit of money, is because they're able to go ahead and not only leverage bank debt, but also leverage other people's equity. So if you have any other questions, feel free to contact me. My contact info will be below. Visit my website. I do also do consulting for sponsors, and I show them how to do these types of structures, how to optimize their structures for the most profits, and also just how to do financial modeling for their real estate deals in general and help them get their projects financed. So go ahead, smash the like button if this video helped you, and feel free to subscribe to my videos for future recordings.